We will now hear from Vice President of Single Family Counterparty Risk Management, Katie Shilinsky. Katie, the floor is yours.
Thank you very much. I'm looking forward to an opportunity to talk to you a little bit more about counterparty credit risk management. First, thought we'd start off by talking about what do we think of when we think of counterparty and what does that mean and how are we structured? So what you see there in front of you is really our comprehensive look at what does it mean to be a counterparty. We've got several teams in this group. We've got our compliance and eligibility team. That's our team responsible for the onboarding and the monitoring of the compliance and eligibility of our seller servicers and our reinsurers. We've got our seller servicer team that manages both the banks and the non-banks and the credit unions. We have the reinsurance team that helps participate in onboarding with our reinsurers and those that participate in the ACES program. Our mortgage insurer team that is responsible for the oversight of those mortgage insurers that we work with. Our core team, which is our examination team, our operational risk boots on the ground team, as we describe them, that is helping perform those exams of our mortgage insurers and our seller servicers. And then also a team dedicated to risk analytics and reporting to kind of pull everything together. We are also including this in the umbrella of our third-party risk management program, which we are continuing to expand within single family. That includes everything that you see there and also is the overarching umbrella within the risk management of our suppliers as well. If we could take a look at the next slide. This is discussing really or reviewing our counterparty life cycle. So what do we do when we look at the entire life cycle process in the management of a counterparty? So first, obviously, there's the compliance and eligibility and looking at the financial requirements. Those seller servicers that are coming on board to be new counterparties with us, we have to first make sure that they're even eligible to be seller servicers with the GSEs. We're performing background checks. We're doing our analysis, making sure that they meet the minimum requirements. Once we've gotten past the approval stage, we look to set terms of business and the approval limits for each individual seller servicer. We move into a monitoring and surveillance phase, which is just check-ins and our updates, and I'll talk about a little bit more of that in a moment. We perform regular financial analysis on our seller servicers, and we conduct those quarterly reviews as needed. As I said, those are our examination boots on the ground team, and we're looking for a risk-based approach to how we're going to perform those and conduct those reviews. Each seller servicer has a limit applied, and and we look for risk rating as one of our tools, which I'll get into a little bit more detail. That circle, as you see on the right there, really continues ongoing. That's part of our regular monitoring of our counterparties. But if something would happen, if we start to see a decline, then we move to the final stage, which would be risk mitigation and potentially even termination if needed. And there's multiple steps depending on the severity, hopefully being able to turn it back into the life cycle again. But if not, we've got a process to follow for that as well. We could look at the next slide. So from a top-down perspective, how do we manage our counterparty risk? Well, we do look at and set a risk appetite on an annual basis, and that's really looking across the portfolio and setting those thresholds of where our comfort is and how we need to set our capital. But to do that, we've analyzed our seller servicers using a stress loss approach. That's looking at the possibility or the likelihood of a counterparty default, a loss given the default, and understanding what our exposure at the default would be. Those thresholds are set annually and reviewed as appropriate. There's strong governance tied to this, and it's also linked into the risk appetite and the thresholds of the overall enterprise. Then we establish a risk rating process. We've got a master rating scale that we monitor our counterparties to. Those are generated by scorecards that we have developed internally. Our management limits are also determined by the risk rating of those scorecards and the size and type of our counterparties. We set a management limit below where the threshold limits have been based on our risk appetite. And we always give even our top largest counterparties that have strong board limits from a concentration standpoint, we set our limits well below those to make sure that we have a cushion so there's no concern or possibility of overexposure. The risk ratings and the limits are reviewed periodically. That means at least quarterly when we get updated financials, more frequently as needed. From a portfolio standpoint, we also look at monthly KRIs and KPIs. That's really just to understand for trends and make sure that we are monitoring the risk of the entire portfolio. there's strong governance around that as they go through risk committees and so forth to communicate where those levels are. And one of the most important things we're continuing to strengthen is the collaboration within single family and across the enterprise to make sure that those counterparties that breach over different areas or expand over different areas, we're being all encompassing and thoughtful, make sure we're capturing the risk in one place. It's really important for us to bring this all together and clearly document how the risks are interacting with each other, and anything that's non-financial to begin with, such as an operational risk, could potentially turn into a financial loss at one point. So that's continuing to be strengthened as part of our third-party risk management process. On the next slide, we've got some detail around our application approval processes for the last few years. We were pleasantly surprised. 2020 was a healthy year for new applications, and that was both for new seller servicers coming to Freddie Mac, people that had not been active seller servicers before, and also applications to turn and add servicing to their approved service with Freddie Mac. They may have been existing sellers, so they now want to be servicers as well. So it was a little unexpected for us as we entered the COVID period of time, but the housing market being what it was a strong growth in applications. As a result, we actually turned down less from a percentage standpoint applications in 2020 compared to previous years. We also took in a lot of the concerns that we were seeing in the early days of COVID to make sure that those new applicants coming on board had enhanced strategies, strong liquidity. Any concerns that we were feeling in those early days, we were in repeated contact with our new applicants to make sure that they were prepared to kind of weather the storm that we were facing last year and beyond. As really has been the case, those applicants that were not approved were really the ones that had weakened historical performance, unproven business models. They had inadequate controls, we felt, around reporting, or they were just not able to meet our minimum standards for across the GSEs. There was also a couple of cases where we just felt the legal issues and the risks imposed were just potentially could lead to reputational risk for Freddie Mac. So that rare case was declined as well. On the next slide, included a look at the minimum financial requirements that our seller servicers must achieve for both Freddie and Fannie. So what you see there on the left-hand side of the slide under the current column is the minimum financial requirements that came out in 2015 that, again, this is for both GSEs, Freddie and Fannie, seller servicers must meet those minimums. In the beginning of 2020, you see the column listed as proposed. Those were what were published and out for public comment. Fannie, Freddie, and FHFA had worked on what we call 2.0 requirements that were supposed to come out later in 2020. Those, however, were halted as COVID kind of hit the industry. We paused the implementation of seller servicer 2.0 eligibility requirements really to make sure that it wasn't complete disruption in the industry during a time where everybody was trying to reassess and understand what was going on, but also to make sure that we were incorporating the learnings that we felt through the COVID crisis. So as we understood the margin call needs, the importance of liquidity, even more so, and the learnings from the stressed environment, we've now taken those learnings from COVID as we've gone back to the drawing board to say, where should seller servicer eligibility requirements now land? So a lot of work has been done between the GSEs and FHFA on this. They are not we call them servicer eligibility 2.1 requirements, aren't available for public comment just yet, but hopefully before the end of second quarter, we will be able to get those out for comment. But I think you can see just thought process from last year, looking at the differences between Ginnie Mae servicing and the GSE servicing was something that was on the forefront of our mind. And then the one thing that was implemented from what you see on that proposed list was the item at the very bottom. We no longer allow availability under unused lines of credit as a form of liquidity. So that piece of it was implemented in December of 2020 ahead of the remaining parts of the eligibility requirements. Okay, I want to get into a little bit more of how we look at our seller servicers first. On the next slide, thank you. And how we do a multitude of different things. We conduct baseline reviews, and there's over 2,000 counterparties that we're doing this on, and we clearly use a risk-based approach of how we're going to monitor those counterparties. We do continue to refine our selection process as we, again, take that risk-based approach to make sure that we give a more frequent analysis and review to those seller servicers that are the largest with the most exposure to us, the most complex. They have more touch points than those who may be smaller and not much delivery to Freddie Mac. We do constant reviews. At minimum, our risk ratings are refreshed quarterly, as I said, to get when we get those financial statements in. And we're looking for any change in the ratings. If there's a needed change in management limits, we review the terms of business. We're ensuring that there's compliance with policies and procedures. And we're looking for any candidates, any outliers that we may need to step in and take some quick action just to mitigate any risk concerns. If we do start to see some issues with our counterparties, one of the first steps that we will do from an internal standpoint is identify a need to put them on a watch list or even a troubled counterparty designation. It's really a signal to our governance team, our management team, that there is a concern here. We're increasing the frequency of our oversight. We're increasing frequency of communication, and making sure that there's awareness of this is something we need to work through to turn this situation around. Those criteria of how a seller servicer is placed on a watch list or is designated as troubled has a very well-defined criteria, but of course we also take judgment into that analysis as well. If we feel there's something that is coming that may not be reflected in the numbers, we always use judgment to add more to those watch list criteria if needed. Looking ahead on the next slide, just some of the tools that we have in our toolbox to help us with this. Looking at the stress loss versus limit, the utilization of the limit is a key way for we're understanding the volume coming to Freddie Mac. We look for anything that's a pattern, something unusual. We're in a frequent conversation with our first line sales teams to ensure what we expect to be delivered. Is that what we're receiving? Again, do we see any change in mix or any difference that we should be aware of? We've got early warning tools that are outside of even our scorecard built models that really are looking for fluctuations in cash flow, any instant change in distribution and capital, something that also sends a red flag that is concerning. While we do have very strong risk rating models that I've mentioned, we also do for those counterparties that have external risk ratings as well. We're looking for the changes. How does the external rating compare to the internal rating? We're coordinating with other business leaders, making sure we're touching base with the analysis that's being done from our economics departments and our research departments, if there's anything else that we should factor into our oversight. And again, we're looking for the operational performance as well. We're not just looking at the financial piece in silos. We're making sure that we're connected to servicing performance, the core examination processes, anything that, well, as I mentioned earlier, could be an operational concern today. How could that potentially turn into a financial loss or a financial concern later on? We also are being very mindful of understanding the business models of the seller servicers and the counterparties that we're interacting with, the uniqueness of the mortgage banks versus the banks, understanding the investment need for technology, and as the changing economy happens, as we see margins tightening, how does that affect the business model? Do we see that mortgage bank, that non-bank, for example, being able to be prepared for what we see coming down the road? And it's very important for us to be in frequent communication with our non-banks to make sure we understand that. On the next slide, we've got a little bit more information on limit setting and loss mitigation. As I mentioned, the risk appetite process that happens annually, it happens in the fourth quarter. It's something that takes us many months to kind of do our analysis, our stress testing, to assess our comfort level, to go through the governance process. But even though we set those limits once a year, we're still monitoring how we're tracking to that risk appetite on a quarterly basis to make sure we're still within our parameters, make sure we're still comfortable. Again, it's the actuals are in the boundaries of where we expected the year to play out. We do continue to refine our probability of default tools, those risk rating tools. Again, COVID is the best example. Make sure that any learnings that we had from that, we have factored into how we think of the potential for default. It's the more history that we gather, the more, well, we don't ever want a counterparty to go into a default situation. The more history that we do gather, or we find it outside of a non-Freddie customer, as it's been in the industry, we're factoring that into, does that increase our probability, or is it something else that we should add to it? Now, if we switch over for just a minute to the next slide, we'll get away from seller servicers and talk about the mortgage insurers. So as you'll see with our mortgage insurers, and I'll lastly touch on our reinsurers, it's a very similar process to the oversight. Mortgage insurers definitely have the addition of PMIERS, which was updated in PMIERS 2.0 in March of 2019. You can see there on the slide a few things that were added as part of that update, the eliminating the inclusion of premium credit for legacy loans, established the counterparty haircuts for risk transferred to third-party reinsurers, and improve the alignment of the quality control requirements with the GSE standards and mortgage insurance recession. The really good news about the comfort that has come from having the PMIERS establishment is it's brought the level and the consistency, a way to communicate and monitor the risk of the mortgage insurers. And it's also giving us comfort, the surplus that we're also seeing, the above and beyond. The average surplus of the 6 mortgage insurers is over $1 billion. And most of them have about 41% cushion, some slightly higher than the others, but that's looking across the 6 of them. And it's a cushion that we continue to monitor. We're certainly happy there's a cushion, but we're keeping an eye on the amount of cushion and the trend for that as well. So looking at on the next slide, the overarching mortgage insurer monitoring framework. It's just as we see with other counterparties. We're looking at the financial strength as well as their compliance with PMIERS. Every quarter, we get the financials from the mortgage insurers. We're looking at that PMIERS compliance. We're doing a business performance review. We do look at an operational scorecard, and that team is assessing the true operations of the mortgage insurer. On an annual basis, we conduct an in-depth analysis of each mortgage insurer. We do periodic on-site reviews with our core team, our examination team, at least every other year. We will change that frequency if there's a concern, but we do work with our mortgage insurers. And then we develop a credit risk rating and a scorecard. All that together assessment helps us assign an appropriate internal rating and determine the loan loss reserve amount for each MI. And lastly, for our counterparties, how do we look at reinsurers? Advance the slide for me. From an onboarding standpoint, we really want to make sure that we're onboarding our reinsurers with robust financial strength. So to do that, we do an in-depth credit analysis. We, just as you've heard for the other ones, prepare a credit risk rating through our scorecard. We do have a good, strong due diligence meeting. We meet with management of the team, the reinsurance team, to make sure that we get our questions beyond the numbers answered and get to know the reinsurer a little bit better. We analyze any public and non-public information available. We do the background screenings, the OFAC checks, Freddie Mac's exclusionary list, make sure there's nothing that pops up from a background compliance standpoint. We assess the willingness to pay claims and the track record, and we do some negative news searches. Once we've done all of that due diligence, we make the decision whether or not we're comfortable with onboarding the new reinsurer. And then once that decision has been made, we establish an internal risk rating, the limit for the reinsurer, and also set the collateral requirements. All of our reinsurers have a level imposed collateral for participation. So that is established at the beginning of the onboarding process as well. And on the last slide, so once we have a reinsurer on board, well, how do we monitor them? Same process. Continuing to conduct the credit analysis of the reinsurer. We're still looking at the risk rating. We're still looking for changes. Again, if a reinsurer has an external rating, we're looking for any changes there. Continuously do the negative news searches. We have developed some pretty strong tools to monitor the limit utilization and forecast for the future. So those are forward-looking tools that we use, but have been very refined over the last couple of years and very strong in helping us making sure we know where limits are going to be. We do also calculate the level of concentration and communicate that, again, assess that between our risk appetite, how are we comfortable with the way concentration of our reinsurance panel is shaking out. And we use dashboards, frequent tools, just from anything from the collateral to changes to external events that may impact our reinsurers going forward. If we feel that any of the reinsurers are close to reaching the limit, we kind of make an adjustment, we communicate that out, and that will rebalance the portfolio as appropriate. We definitely can ask for additional collateral and change the limits as needed to ensure that everything is within our comfort and within the risk appetite. So with that, that's a deeper look into our counterparty world and our ongoing monitoring of those counterparties. I will conclude the presentation, and Cass, turn it back to you.